And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Three of the best in the business, as always, with us again today. Armando Senra, head of BlackRock's iShares Americas. Kevin O'Leary, chairman of O'Shares ETFs and Shark Tank's co-host. And Jim Lowell, CIO of Advisor Investments and Fidelity Investments, editor-in-chief. Armando, let me start with you. iShares is the largest ETF family in the world. You're the guy in charge. Give us a quick overview of ETF trends this year overall. We're still seeing inflows, but it's a little bit lumpy. What's going on?
Yeah, sure, Bob, and great to be here. Let's just begin. It's been a roller coaster of a year for all of us in our lives, and it's no different for the ETF industry, but overall it continues in a strong path for growth. So you have seen a strong adoption of fixed income ETFs. That's a theme that we've been talking about for quite a long time. You've seen strong growth in sustainable, and that's something that year to date that represents 20% of our flows. And you and I would talk about it at the beginning of the year. So very strong growth. We've seen investors becoming more aware and concerned about inflation, and you've seen flows into commodity ETFs. You've also seen, especially during the summer, flows into tips, again, because of inflation concerns. And the other thing that has been interesting at the beginning of the year, you saw quite a bit of outflows from anything international equities related. And you're beginning to see now, with a weaker dollar and also the underweight positions that most investors have to international, you're beginning to see flows back into international. So I would say those are the main themes: fixed income ETFs, the growth of sustainable investing, and what you've seen this year in terms of risk on and risk off and how investors have played that out.
Yeah. Kevin, you've had a good year. Speaking of flows here, we were talking earlier about your internet giants ETF, OGIG. You're hitting on all the right notes here. It's 70% gain, I think, so far this year. Notable inflows, I think 300% increase in the shares outstanding there. I guess the question is, you're hitting on all the right stuff. You own the big mega caps in the U.S. You own the two big China mega caps, Tencent and Alibaba there. How much longer do you think we can still have interest in these broad mega cap names before something else like value starts outperforming?
Yeah, I think value just leads you into some pretty dangerous territory, like food services and lodging, hotels, cruise ships. I don't consider those value. I think they're dangerous. What's happening with OGIG is basically the world is changing. It's doing a digital pivot. It doesn't matter if you're doing it here in the U.S. with the FANGs, which are included in OGIG, but it's also happening in Asia. It's happening in Europe. It's happening in South America. And the trend is that people have decided, and of course it's COVID related, but for the first time a whole new generation of people are going online and buying goods and services direct from the various businesses they get it from. You saw it in Nike numbers, for example. But what OGIG tries to do is find the 70 or 80 companies around the world that are the giants that are leading this trend. And I don't think we're even in the third inning yet, because the pandemic is just one attribute, but it's not about staying at home and working. It's working from anywhere and buying anything from anywhere, delivered anytime. And so that is really the engine of what has made OGIG so successful. And I think we're just at the beginning, Bob.
Yeah. And you were one of the guys, Kevin, that was into factors very, very early. You were talking about high quality, low volatility as a factor. And OUSA, I think this is the 5th anniversary for it, was a dividend, but essentially went into the factor area. And factoring has proven to be very successful. There's some academic evidence that factors tend to outperform, but when applied to specific areas, they can also do a little bit better. So OUSA is what, 5 years old now, Kevin? This is a dividend.
Yes. ETF. In fact, I remember you were there when we rang the bell on it from the balcony. I'm very excited. It's a big deal for an ETF to get to its 5th year, because that track record really matters in terms of people looking at performance. And it's a dividend strategy, but a quality dividend strategy. And factor really matters. The quality of the balance sheet, the return on assets, sustainability of the business model, the free cash flow, how much debt does the company have? So if you looked at the S&P 500, there's many sectors and many companies I wouldn't want to own. For example, some of the energy stocks, which have 8, 9, 10% dividends, you'd think they'd be great and they would show up all over the place in dividend growth stories, but they are not safe. And I don't think those dividends are safe, and they are certainly not in USA. We've made sure that it's just quality. So it's a subset of the S&P 500, about 100 stocks that we feel are safe to own during these really volatile times.
Right. That's an important thing. It's not a high dividend fund that you're running. It's a dividend fund with quality overlay on it. And that's where you get the distinction with, for example, leaving out the energy stocks. I want to move on and talk about ESG, environmental, social, and governance. Jim, let me turn to you. My attention was really caught last week when Burton Malkiel, a man I greatly respect, the author of A Random Walk on Wall Street, which essentially said you can't outperform the market 45 years ago, his famous book, did a editorial in the Wall Street Journal last week saying sustainable investing is a self-defeating strategy. He complained that the scores from different providers on ESG differed dramatically. Jim, what I've noticed is there's a little bit of pushback on ESG this year. Some of it's ideological, some of it's from oil companies, some of it's from conservatives who don't like this, what they consider to be pushing social policy. Here's Burton Malkiel even making some points about this. Is this a real thing here, this pushback on ESG, and is it going to impair the growth of ESG at all?
Doubtful on all counts, although, like you, I'm a big fan of Professor Malkiel's. I believe he still works at Princeton, where, of course, Princeton's own money management company's slogan is invest well and do good. I get the ideological pushback, but look, investing in businesses that can profit from accelerating change for the better makes sense to me. Of course, you have to be very selective in what you're investing in, but if you take a long-term view, alternative energy, biotech, more equitable access to healthcare, technology, less invasive medical equipment and systems. I mean, these are all things that we can not just believe in, I think, but profit by. But that doesn't mean, of course, that the classic counter argument, make as much money as you can, any way you can, and then do good things with that money, doesn't continue to make sense. It certainly does, and I guess it's hard to think of a building on Princeton's campus that isn't named after someone who pursued that line of reasoning.
Armando, let me let you weigh in here on this. You run some of the biggest ESG ETFs out there. SUSL has been tremendously successful. ESGU also tremendously successful. XVV also out there. How do you feel about this pushback here? Let me just say, if Professor Malkiel came out and said the scores from different providers disagree dramatically. He noted very different ratings for different companies, say Intel, Pfizer, Comcast. He specifically cited, depending on which rating agent you go to. He also noted there's no studies that show ESG provides higher returns necessarily. I'm not sure that's necessarily the point, but is he making valid points about this? How does the industry respond to Professor Malkiel's comments?
Yes, Bob, and I think that the sustainable has really gone from being about values to be about investment risk and investment performance. And I think that has been a big change that eliminates what it was a very polarizing conversation in terms of what do you believe in. This is not about whether you believe in climate change or not. This is about investment risk. And the fact is that ESG-related risks have an important consideration to asset pricing and ultimately to returns. So that's the big change that we have seen in the conversations with all types of clients, whether it's wealth clients or institutional clients. And that's the big change that is driving all types of investors to begin to incorporate ESG considerations in their portfolios. And there's different ways in which they can do it. They don't have to deviate from the benchmark. They can take a more pure approach to ESG investing, but then they'll deviate more from the benchmark. But you're beginning to see how they're incorporating those ESG-related considerations. And the fact is, going back to your point, these ESG-related risks are not necessarily new, but now we have much better technology and data to be able to account for them, to quantify them, and therefore to be able to take them into consideration when we are building portfolios. So this is not about values. This is about investment risk. This is not about not making money. Ultimately, we have a fiduciary responsibility with our investors. It's not our money. It's our clients' money. And therefore, performance comes first. And that's what we need to offer. And that's why we also have dramatically increased our offering of products for investors so that we can work with them along the spectrum of different options as to how they want to incorporate ESG into their portfolios.
Yeah, I think it's very interesting. First of all, there's some very valid points on both sides. I have generally been in favor of the whole ESG movement, and just because it's difficult to quantify doesn't mean you can't do it and can't get better at it, and people are demanding it. So there are clients out there that want it. It's interesting, Malkiel doesn't say don't do it. In the editorial, he concludes by saying, if you're doing it, the best way to invest is low-cost index funds. Of course, it's Burton Malkiel, but then he says, if you want to do ESG, do it as an add-on to investing in broad, low-cost indexes. He doesn't come out and specifically say, oh, no, don't do it. He just sort of raises, here's some points that you ought to be aware of, most of which I think are valid. I want to move on here and talk about a couple of other quick topics while I've got you, the brain trust here. We are, Jim, we're less than a month before the elections here. Polls are showing Vice President Biden in the lead. We're not politicians, but what, if anything, would a Biden victory mean for ETFs and the mutual fund industry, or even if a Democratic sweep of the Senate? Would it have any impact on the ETF or investing industry?
Well, broadly speaking, if it was a sweep, Wall Street would probably have a hiccup just due to the fact that it tends to favor gridlock. But a Biden win, I'd say, is almost priced into today's market prices, given that all the polls suggest that he's significantly ahead of the president. Where I think it favors most will be in the overlooked, underappreciated, unloved areas. The value side of the ledger, as I suspect we'd see a massive stimulus injection this time, tied to actual job creation, not just for roads, bridges, sewers, pipelines, but also for the information technology highway that as a still developing democracy, we need to ensure equitable access to opportunity among all of our citizens. So I think you might see value begin to at least be a second oar in the water next to the growth side in technology, rather than just spinning on the axis of technology in 2021.
Yeah. Kevin, you want to take a swing at this? I mean, one thing that's very interesting to me is they seem to be talking about two different kinds of stimulus programs. One is the stimulus that Pelosi and Mnuchin, are discussing. But then the street seems to be actively discussing what, if anything, would happen if the Democrats were in power and there was a separate stimulus plan. Jim seems to allude to that with infrastructure, for example. Does this mean anything to you? Is this on your radar at all, Kevin?
Yeah, it is. I mean, I would say, first of all, I've learned since the Brexit vote never to use polls to make investment decisions. They're entertaining, but they do not determine outcomes. So the question, let's make the assumption, as you said, that Biden wins, and even it's a Democratic sweep, fine. He'll inherit an economy somewhere between 8 and 9% unemployment. His number one mandate will be to get those people back to work. So let's take the idea of raising taxes dramatically to corporations. Highly unlikely. You're going to spend $1 billion to $2 billion, or sorry, $1 trillion to $2 trillion from the top. You're pouring that on the economy. It makes no sense to tax it away as soon as you deliver it. So there'll be a delay on tax increases, I would assume, for probably 24 months until he got unemployment below at least 5%. Given his age, the chance of a second mandate is very, very low. So I'm going to make the assumption he'll be tied up. His hands are tied in making any dramatic policies. Let me give you an example, the Great Green Deal. That would displace about 250,000 to 500,000 people working in the energy space right now. Highly unlikely when you're at 8.5% unemployment. So I'm going to make the assumption that even if the reason the market's ignoring this election more or less is Biden's going to be pretty benign. He won't be able to get much done, if anything, towards these dramatic changes in policy, and that'll be left for the election after he's finished his first and only mandate. And I'm not trying to be critical at all. Age is a factor, obviously.
Yeah. Armando, just briefly, the taxation on capital gains is the one thing the trading desks always say, oh, that's something we're really worried about, because he does have that in his policy. Is that a concern for the ETF industry overall and the investment industry overall, or do you feel like Kevin that it's unlikely a lot of these proposals will get enacted?
I agree with Kevin, and I think that what matters the most is number one for investors to stay invested. I mean, if Biden wins, you're gonna see large fiscal stimulus that is gonna come and support the market. So ultimately, the most important thing is to have the election over. That will remove the uncertainty, and that will be good for the market.
Okay, let me move on here. We have talked a lot here about the fee wars and what it means for consolidation in the industry. Interesting development last week. The hedge fund run by Nelson Peltz has taken an almost 10% stake in Invesco and in Janus Henderson, signaling they want to push some of these asset managers to either be more efficient or even possibly consolidate. We have talked about this before. Armando, you're the king of the hill here. BlackRock and Vanguard are the two biggest ETF families out there. Let me just ask you, Armando, and all the guys, all three of you, do you feel that consolidation in this industry is inevitable, and 2021 will see more consolidation?
Yeah, Bob, we've said for a long time that the scale is necessary, and that leads to consolidation in the industry. Ultimately, if you think about the scale, what it allows you is to bring innovation to the market, to deliver quality and value to investors. So I think scale is necessary. And I think that without the scale, I mean, think about what we've done this year, our ability to bring to market at the scale with quality over 40 new products. So that's something that you need to do with the scale. So yes, we've seen it before. We've mentioned that before. We do believe in consolidation in the industry.
Yeah, Jim, that seems to be the answer to everything. Bulk up on your assets under management. Easy to do if you're BlackRock. It's a little tougher if you're everybody else out there, right?
It definitely is. Look, you can count the number of mutual fund companies that an average investor could name. Probably two: Fidelity, Vanguard, maybe T. Rowe Price. There's an industry that went through massive consolidation. ETF industry clearly going to do much the same. And for the benefit for the retail investor and the professional advisor, it usually leads to lower costs for the underlying products, whether they're actively managed mutual funds, passive indexes, or ETFs. So I think you're absolutely right, Bob and Armando, that trend is in place.
You know, Kevin, I'll leave the last word with you. Maybe the answer, if you're struggling, is to come up with new innovative products. I mean, look what you did. You set up O'Shares, and you've got a dividend fund that doesn't just buy the high dividends. You overlay it with a quality overlay. We just talked about that. There's an innovative product. You're doing pretty well like that. Don't you think the future is, other than just, let's get more assets under management, let's have more innovation, more innovative products? Isn't that the answer, or do you have some other brilliant explanation or what we should be doing?
No, I think you're right. I think you need both. I mean, the truth is there is a barrier to entry into the ETF market now. You don't see a lot of new firms opening up because until you get $1 billion under management, you're not making any money. Compliance costs are significantly higher than what they were just a few years ago. So that's a factor. Innovation really matters. Clearly, you know, getting the first 50 million into an ETF gives you some indication of whether there's interest there or not, but you never know till you go out there and put it out. I mean, I built these indices to serve, you know, my companies and my family trusts. I like to have a hand in what I invest in, and that's why I did it. I mean, it's a little unique because I can afford to seed my own products. But at the same time, innovation will always drive this market. And the thing about the ETF itself as a structure, it will ultimately be the most successful investment vehicle for institutions and individuals because it's transparent, it's efficient, it's low cost, and it's incredibly tax efficient. So I feel that we're really only in the fourth, maybe the fifth inning of what this sector is going to be. And the innovation that comes in the form of factor-based or actively managed or all the other ideas that are being floated are incredibly healthy. Obviously, because of COVID, we haven't gathered like a flock somewhere like we usually do in South Florida, but hopefully next year we'll do that again. And I love those sessions and those seminars and when the industry gets together and says, what can we do for clients? But clearly we've made it far less expensive and we've delivered tremendous diversity as an industry. And the clients know that whether they're a sovereign fund in the Middle East or they're an individual investing in California. We do it for everybody.
Yep, and that's why the show exists, ETF Edge, because ETFs are a very efficient investment mechanism. Thanks, guys. That does it for this week's ETF Edge. My thanks to Armando and, of course, to Kevin and Jim. And remember, you can see all of our podcasts on etfedge.cnbc.com. And don't forget, we've got, in addition to the podcast, we, of course, got the programs, you can see that, and the podcast. And we talk all about individual ETFs on a regular basis. And in the podcast, we go into a little more detail about what's going on in the ETF business. In this week's podcast, I'll talk a little bit more about the consolidation in the ETF industry that we were just talking about. Thanks, everybody, for joining us. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.